Good morning, clients and guests. My name's Patrick Malcolm. I'm from GFM Wealth Advisory. I think spring in Melbourne is taunting us at the moment. We've had 2 wonderful days. We're well and truly understand how tough things are for everyone at home. We hope you're doing as well as possible. In spite of all that, it gives me great pleasure to be speaking with 2 people from Perpetual today, in Jack Colopy and Alex Patton. I will introduce them in a moment. It's a very special day for the fund that we're talking about today, the Perpetual Pure Microcap Fund, which actually turns 8 today. I certainly won't do a rendition of Happy Birthday, but nonetheless, we're able to talk about the impressive long-term track record of the fund. As well as having 2 guests today, we've got 2 disclaimers today, both the Perpetual disclaimer and the GFM Wealth disclaimer. Just so everyone understands that we use our webinars and our seminars, this is general advice. If you need specific advice around your situation, you need to call and speak to one of our financial planners. So to start the webinar today, I'm going to introduce Jack. Jack, thanks for joining us.
Thanks for having us, Patrick, and hello to everyone out there.
Beautiful. Now, can you tell us a little bit about Perpetual and your background at the company to start with?
Yeah, so Perpetual is one of Australia's oldest fund managers. We currently sort of manage around $14 to $15 billion, and since then, that's in the Aussie equity part of the business. I've been at Perpetual for 20 years. I think my anniversary is not coming up till November, but it's been sort of my lifelong career.
You don't get that long for murder these days, Jack.
I know. I mean, I've been very fortunate to work there and work under some very good investors and be given opportunities along the way, which is something that we try and do still nowadays, sort of bring company people through the business. And that's been rewarding for me. I've been managing the small cap fund at Perpetual for 12 years. And as you said, the micro fund is now coming up to its 8th birthday. I started that fund. We're sort of proud of what we've done. The way we invest, I think, is probably of interest to your clients because when people think micro caps, people think of high risk, speculative companies that are unprofitable. But the way we do it is quite the contrary. We invest in the micro cap space exactly the way we invest across all our Aussie equity funds. And so those companies we invest in have to be profitable. They have to have good balance sheets, good management, and recurring profitability. So these are the businesses that we can understand. They generally trade on attractive valuations. And those quality filters, as we call them, being profitable, good balance sheet, good management, they really are based on preserving capital. So rule number 1 to make money is don't lose money. And our approach, I think, differentiates us a little bit from some of the competitors in our space because of those risk mitigation that those quality filters provide. And sometimes, it can be, we won't have these, super sexy multi-bag kind of market darlings, but we certainly have a strong sleep at night characteristics in the portfolio, which we think is more important and certainly valuable to our clients over the long term.
And we'll certainly talk about the numbers for the fund a little bit later in terms of those metrics that you spoke about, Jack. So, Alex, welcome. Good morning.
Morning,
can you tell
Patrick.
us about Thank you. Can you tell us about your role in the business and your background as well?
Yeah, absolutely. So I started at Perpetual a bit over 9 years ago now, initially working in our finance department. I had a range of roles throughout the business, also completed my chartered accountant's qualification.
You poor thing, Alex.
Yeah, that's right. And then I got the opportunity to move into the Aussie equities team as an analyst about 6 years ago now. I've had the pleasure of working with Jack since then, predominantly on the small cap and micro cap fund, just helping him look for new opportunities and just making sure we're on top of the positions in the portfolio.
Yeah, and like many Perpetual or ex-Perpetual staff, you've got the accounting background, which is interesting, yeah?
Yeah, that's right. I think that really helps, just to read financial statements and, a big part of our process is to really look in and try and understand the earnings quality of the business, looking through the cash flow, and obviously there's a big focus on making sure we're investing in companies that have rock solid balance sheets as well. So it definitely helps from that perspective.
Absolutely. So, Alex, just to start with, can you sort of touch on there's the economic themes at the moment? I think it's very, very hard to talk about the share market without talking about the economy. I think that's always the case, but there's never been a case more so than at the moment. So can you sort of talk us through the economic themes that you think we should be keeping a close eye on?
Yeah, absolutely. I mean, the first thing I'd say is that everything that we've seen over the last 12 to 18 months has just reminded us that it is so difficult to predict the economy or economic developments with any level of confidence. I think that's clear. So after the initial COVID impacts last year, we saw the government step in a really big way, provide a lot of support payments and government stimulus. And as I'm sure everyone's aware, we've seen the Australian economy rebound extremely quickly and extremely strongly on the back of that. And beginning late last year, we started to see a bit of a rotation in the stock market away from those growth style names towards value style stocks. And that's sort of the first time that we've seen that for a number of years now. So a lot of those value style names are a bit more economically sensitive. So the stronger economy here in Australia and globally has really been a big tailwind for them. Another thing that the market's become more focused on in the last 6-9 months really is the risks around inflation and the potential for higher inflation to come through. And that's leading to people adjusting their expectations around interest rates, and the likelihood of rate rises in the near term is definitely increased. And that as well is supportive for value style names as opposed to growth names. I think it's worth noting, though, that the valuation discrepancy between value and growth, or maybe another way of saying that the really expensive loved stocks in the market and the less expensive stocks, that discrepancy is still at all-time levels, and these growth style stocks are still extremely expensive relative to history. In terms of what that means for our microcap fund, we continue to invest as we always have. We think the fund is extremely well positioned. We've got lots of great Australian businesses that we think are really still attractively priced and overlooked by the market generally. Our funds, it's a little bit different to most other microcap funds out there. We're not, as Jack said, we're not chasing the hot stocks of the day or those high-flying, unprofitable tech names. We're just looking for solid, stable businesses that are run by honest and competent managers. And we think we've got plenty of those in the portfolio. So everything that we invest in the portfolio first needs to meet our quality filters. And so we're looking for businesses that are, of course, profitable with a track record of earnings and that have really good balance sheets without too much debt.
Cool. Understood. Now we're getting to the end of reporting season, Jack. Must keep you guys awake at night every year or every 6 months. Can you give us an assessment of reporting season, particularly concerning what you've got in the microcap portfolio, and your overall assessment of reporting season and the impact of COVID both now and moving forward?
Yeah, sure, Patrick. So it was a very strong reporting season overall. Obviously, there was some sort of coming out of the initial COVID lockdown, sort of April last year. There's a lot of stimulus around. People aren't traveling, so they're saving. Interest rates are very low. So the actual corporate profits were overall very strong. But it was quite strange, I guess, looking backwards, which reporting season is, whilst we're in lockdown, I guess, and the uncertainty that we're sitting in as we're looking back, analysing historical profits. But the market overall, looking forward, is generally looking through this sort of East Coast lockdown and that uncertainty, taking sort of comfort from the experiences overseas, UK, US, and that open up trade that should come with the vaccinations. But from our company's perspective, we were very pleased. The fund was actually up, more than 7% in August. So overall, our companies reported very well. But that uncertainty, I guess, whilst we're in lockdown, sort of remains. But I guess there's a fair bit of optimism around reaching vaccination levels and the economy going from strength to strength, and profits continuing to be good into FY21.
Do you think we'll get as much of a
22.
sort of kicker as we come out of this lockdown as we did last time, Jack? Or do you think it'll be different?
It'll be different, I think. I mean, there is less stimulus around. Obviously, they threw a fair bit at it, this time last year. But if you look at employment rate is very high. The resources companies over in Western Australia scrambling to get people. I think the economy is in good shape. The companies also have cut a lot of costs out, and that's driving increased profits. It was a rare opportunity for them to take costs out, make decisions that they potentially wouldn't have made without the COVID pandemic upsetting their businesses. And they're a lot leaner and more efficiently run, a lot of the companies that we've invested in. Whether they can keep these costs out, they'll probably creep back in. I mean, whether it's simple things just like traveling, entertainment, some of those, you could argue excess costs that creep into corporate cost lines, they may creep back in slowly, but overall it's been a good opportunity to take costs out.
Absolutely. And Alex, just back on the inflation piece, I think this is the really hard thing with inflation at the moment, isn't it? That there seems to be lots of both things that are inflationary and deflationary at the same time. So our outlook for inflation is murky, isn't it?
Yeah, absolutely. I mean, we, in all the conversations that we had with our portfolio companies, we spent a bit of time talking about the cost pressures that they were seeing. And for a lot of them, they were things like higher freight costs, higher raw materials costs, and it's probably realistic to assume that some of those inflationary pressures are temporary and will go away as supply chains become less disrupted. But at the same time, most companies are having to pay a little bit extra to retain staff or to find talented staff, especially given the Australian borders are obviously closed to immigrants. So I guess that was a theme coming out of reporting season. A lot of companies are seeing a bit more inflationary pressures than they have seen in the last few years. But you're right, Patrick, especially given this more recent lockdowns across the East Coast driven by the Delta variant, that is clouding the outlook somewhat.
Absolutely. Now, Jack, I'm going to get you to talk about a little bit of how you guys manage money within the fund in a moment. But before you do that, I just wanted to highlight the performance of the fund since its birthday 8 years ago. So it's averaged 19% per annum. We know you guys use the small cap index as your benchmark, but we like to use the emerging companies. That's made 11% over that period of time. And I guess one thing that gets lost when you use annualized returns is it doesn't sort of give you that a sense of what the compounding effect of what those higher returns have been. So that cumulative return for the benchmark is only 130%. The cumulative return for the fund is 300%. Simply put, someone that had put $10,000 into the fund at inception would now have $40,000. I think what's most impressive, and you talk about the perpetual process, Jack, is the downside capture, i.e. how far the fund falls on average when the market falls is only 35%. And then when we look at the measure of risk in terms of standard deviation, the fund's actually taken on 12% less risk than the emerging companies index. So it's performed amazingly well, but in a more risk-controlled manner than what the benchmark has done. So I just wanted to let our clients know that before you start to talk about the process with the fund. So could you please explain how you manage money within the portfolio?
Yeah, sure. No problems, Patrick. I sort of alluded to those quality filters and the way we invest at the beginning, but I think we really can't emphasize it enough. Those 4 quality filters. So we only invest in those companies that are profitable and with a good balance sheet. And when we say good balance sheet, we mean pretty squeaky clean, mostly net cash, because these companies are relatively small by definition, and perhaps they don't have access to equity markets. So we think being really disciplined on the balance sheet and having minimal to no debt is really important, and it goes a long way to conserving capital and de-risking the portfolio. And also that management piece, I think rule number 1 of small caps and micro caps is management. And if we look at our fund, some of the best performing stocks and our longest held stocks are really because we're backing management and long-term investors. We don't trade a hell of a lot. A lot of the companies we've held for 7 or 8 years since the outset. Sometimes those positions grow as we get more comfortable with management, and there's a high level of trust and conviction. So you'll see some of our best performers are in fact some of our longest held companies, where we have quite large stakes in the businesses as well. So we have very good relationship with management, very good access to management, can help, sort of guide them where they might need guidance in terms of the market, in terms of capital management. But we're very involved with the companies that we own. We meet with a lot of companies, but we're generally long-term investors backing businesses that we understand, businesses that are growing, and management that we trust.
Yeah, the fund is absolutely index agnostic. I pick up the point here, no tracking error. Tracking error is completely off the charts for this fund, which is 13%, which effectively means you guys are really ignoring the index, which is great, and just finding good companies, which we can see on this slide here. So you're taking a universe of 1,700 stocks. Of that, you're saying that only 80 fit the perpetual quality filters?
Well, I mean, that's in our universe. There's a lot more out there, but often we only bring them in if we want to own them. So I'd say that number would be higher than that. But we do have quite a concentrated portfolio, as you can see, as we whittle that down to around 35 stocks.
So I know this is a little bit hard because when we talk about stocks in the top 100, the very vast majority of people are familiar with those really big companies. Could you give us an example of a company, or just a conceptual example of a company that you guys would put a line through that wouldn't end up in the portfolio?
Yeah, so with those, coming back to those quality filters, there's a lot of companies out there that don't make profits. So I mean, there'd be a myriad of companies that wouldn't make it into there just based on that profitability filter. But one that people might know that we've never owned and will never own would be something like Mesoblast, biotech companies where you've got sort of binary outcomes on, sort of testing and continually need money, whether that's issuing more shares or getting money from the bank to keep funding research and development. For us, that is way outside of the style in which we invest. So that would be an example, Patrick.
Cool. Now, I want to pick on some of we can see that the portfolio is quite punchy. When we look at the largest holdings in the fund as at the 30th of June 2021, and they have changed a little bit since then. I got the most recent fund profile this morning. Capral and Enero continue to be the 2 largest positions in the fund. So Capral, can you explain the business, Jack, why it's in the portfolio, give our clients a sense of what you like about it?
Yep. So we've held Capral for a long time. It's been a good performer recently, but what we liked about it when we first added it was a bit of a sleeper. No one looked at it. It had a lot of tax losses within the business, franking credits, that were all not valued by the market. So Capral makes aluminium products, sort of extrusion. A lot of these products, sort of metal bashing, as a colloquial term, but a lot of these products go into windows, so they're very supported by the housing cycle. And then there's quite a lot of other industrial uses, whether it's in ships. And then so what's happened really is the cycle has picked up. As we all know, the housing cycle and building products is very strong. So they've benefited enormously from the uptick in demand. But what they did when the market was soft is they really took a lot of costs out of the business. They rationalized a lot of their plants. They did some sort of sale and lease back of some of their real estate and really lowered their break-even costs. So as the tailwinds have started to come through, their profits have surged enormously, but so's their share price. But at the same time, you're getting a massive dividend yield because of those old franking credits and tax losses from sort of way back, 20 years ago, that it was sitting in the shell that no one really valued, but we did and knew that when profits and dividends came back, they come out fully franked. So the share price has run on a fair bit, sort of up around $8. It's got about $3 of net cash. It's got 7% dividend yield, which is fully franked, and it's seeing strong utilisation of all its plants.
Sounds like a business that Perpetual would want to own in their portfolio. Seems to be a large amount of sort of net tangible assets tied up in the share price, even at current levels, Jack.
Yeah, that's right. So the NTA would probably be around that $7. So it's not trading much above NTA, even though the share price has more than doubled in the last couple of years. They also had an approach to buy the company, but they had a profit upgrade on the same day, and the share price was trading higher than the bid. So the shareholders sort of kicked that away, and it was pretty cheeky and a little bit opportunistic. But certainly we continue to hold a large position and collect the dividends. And coming back to that management piece and the good job they did, when the cycle was against them, they're really reaping the rewards now.
Are they still likely a target? Do you think that party could come back, or another party could come back and knock on the door, Jack?
Yeah, I mean, I'm not sure if it's probably pretty opportunistic of that private equity firm, but just given the valuations, you would never say never. I mean, you're sort of talking about an ex-cash PE of 4 or 5, and I think it's not improbable, but we'll have to wait and see.
Have you sold any of the stock in the strength, Jack, or have you or has the fund sort of maintained its position?
Yes, we sold a little bit. We sort of like to back foot sell with our value approach to managing money. When people are, the ducks are quacking, we feed them, as some people like to say. So we sort of sold some on the back foot, but just with the share price appreciating, the position's still quite big, but we have back footed some selling.
Cool. Thank you, Jack. Now, Alex, I'm going to ask you about a very different business, Enero, which I don't think many people would be familiar with. Can you talk a little bit about the business and explain why you've got it in the microcap fund?
Yeah, absolutely. So similar to Capral, we've held Enero in the fund for a long period of time. The business itself it's a collection of media agencies. They're headquartered here in Australia, but they've got operations as well in the US and the UK. We put on the slide there some of the key agencies within the group. So first of all, Hotwire. Hotwire is based in the US. It's a PR and communications media agency. So they've got all their clients are in the technology space or the technology sector, and they're helping those companies with their PR and communications to the market, which, as you can appreciate, is very important for those companies. Their clients include Facebook and eBay and IBM. And then another key agency is BMF. They're a creative media agency. So they help their clients come up with content for advertisements, and they help their clients market their business. So, if you think of some of the advertising you might have seen on TV for Aldi, whether you like those ads or not.
Those television commercials are very annoying, Alex, but nonetheless,
yes.
we don't forget them, do we?
That's right. Well, I think that's key, isn't it? Any publicity is probably good publicity.
Absolutely.
So that's what BMF do. And then there's OB Media as well, which is a programmatic marketing platform. In plain speak, basically, it's a piece of technology that connects publishers with advertisers, and they take a clip sitting in the middle. In terms of why we like the stock, I think foremostly the underlying media agencies are really well regarded within the industry. We've got a graph on the page there. You can see the organic earnings growth of the business has been exceptional over the last few years. Those media agencies have been taking market share, winning clients, and doing very well. And on top of that, those agencies are heavily exposed to some really great sectors to have exposure to. So technology, healthcare, consumer staples, they're all parts of the economy that are growing nicely and are really importantly quite resilient. And we saw that through COVID. Enero performed very well and grew their profits and revenues through that period, which was really pleasing. Also, the business has a great balance sheet, $50 million of cash sitting on the balance sheet and no debt. And we still think that the valuation is really attractive. Just looking at the dividends they've paid over the last 12 months, the stock's trading on a close to a 5% fully franked yield. It's trading on about 12 times price to earnings. And to put that into perspective, the broader markets are probably on 16 to 17 times price to earnings, but that's brought down by resource companies. If you look at kind of just the industrial companies, X Resources and Financials, the market multiple is probably, it's well into the 20s. So we still think Enero is very attractively valued here.
So you're buying a business that's growing faster than all those companies, but paying almost, a 40% discount to the market multiple.
Yeah, that's it. That's it. So, yeah, look, I think, that's the beauty of investing in microcaps. You can come across these businesses that have probably been overlooked by the market in the past, or that are still underappreciated. It's a lot harder to find those sorts of companies in the large cap space.
And it seems like you're getting exposure to some themes that people play through underlying stocks, technology, healthcare, consumer staples, and paying really, really big multiples for those businesses at the moment, aren't they?
Yeah, that's absolutely right. If you take Hotwire, for example, they're sort of seen as the preeminent media agency to help their big US tech clients with their PR and communications, and you can see that in terms of their earnings and their growth. They have a lot of exposure to that sector, which is growing so strongly at the moment.
And the cash on the balance sheet, Alex, do you think that that'll just sit there, or do you think they'll use it in a particular way?
Look, I mean, they're paying a nice dividend at the moment, which is good. But on top of that, you're right, they do have a lot of cash. I think they're quite keen to do some M&A and to try and find some more high quality agencies around the world. So I think that's definitely a focus for them as well at the moment, just given how strong the balance sheet is.
So it's not a roll up though. They're not looking to sort of just buy as many businesses and bolt them in. It's sort of sensible acquisitions that fit what they're doing.
Yeah, absolutely. And that's, we've been clear, in our conversations with management that we want to see them take a pretty measured approach when it comes to deploying that capital, which sits on the balance sheet.
And super attractive dividend yield for what looks like a growth stock.
Yeah, absolutely. That's right.
Cool. Now, the last one we're going to talk about, Jack, and I'm not sure you're allowed to do this as a fund manager, but you've got another fund manager in the portfolio. I think they're going to kick you out of the fund managers club for having another fund manager. Now, it's not technically a fund manager. I get it owns other fund managers, but I find this really interesting. It must be a business that you find easy to understand and would understand well, given your background at Perpetual. So can you talk about Pacific Current and why you've got it in the portfolio?
Sure, no problem, Patrick. So Pacific Current's a business we've owned for quite a number of years. They have minority shareholdings in fund managers. So it has metamorphosized into owning mainly US fund managers over the years. And what's attractive about Pacific Current, they don't own long only just equity fund managers, because that for us is not that attractive. what they do, they own shares in sort of boutique fund managers, but in different asset classes. So that differing asset classes is what gives us, attracts us to it, because it mitigates a lot of risk. It just doesn't fly up the profits with the share market and then fly down, with the profits as the market falls. You'll actually see their profits went up during the first COVID outbreak, partly because of currency, but also partly because of the nature of their asset classes. So those asset classes include a life insurance business where they trade life insurance policies. So that is obviously quite counter-cyclical, or it has no correlation to equity markets. Other funds, they have a private equity funds that are closed, so they're not marked to market, they're long-term investors. Also a property business, a fixed income business, so sort of bonds and term paper. And also, which has been a little bit more topical of late, certainly yesterday, which was coincidental, but we'll take it. There's a press around, they own a 5% stake in a very large fund manager called GQG. They sort of helped to seed this business about 6 years ago, and they've gone from zero to $84 billion in emerging market equities. So the press have speculated that the owner wants to list potentially in Australia, and he's doing the rounds in the next few weeks or so, with a potential eye for, an upwards of potentially a $5 billion listing. So that's given the share price a bit of a boost yesterday, which was pleasing. It was up 16%. So, that's been a good benefit for the unit holders in the micro cap fund, but it's still very cheap versus other competitors. PE is 14, dividend yields, 5%. They've had quite a bullish presentation and a good result this year, so flagging further inflows into those various boutiques. But it really is, the whole is greater than the sum of the parts, I guess, is one way to explain this business. The funds, a lot of them are closed end, i.e. the money just doesn't fly out the door. That diversification through varying asset classes and also that offshore exposure, we think adds a lot to our portfolio, and that the strong dividend yield, and it's still got some franking credits, which they are very keen to pay out management, overall makes it an attractive investment.
So Jack, this business that was the catalyst for the share price appreciation yesterday, what will happen with that holding? So will Pacific Current keep that stock, or will they sell it? Or?
Well, it's still a little bit murky because there's so many unknowns. If I don't know, but it will provide a strong look-through valuation if the company is listed. I certainly know that much. We sort of value their stake between sort of 150 and $280 million, depending on the valuation it lists with. But it just gives it, a strong look-through valuation, and then potentially down the track, they may be escrowed if the IPO goes ahead, but then maybe they sell that stake and reinvest it. But the market cap of Pacific Current yesterday was basically worth about the whole GQG stake. You're getting the other 60% of earnings for free. That's how cheap it was. Yeah.
So what's the general strategy? Do they stay in these businesses long term, Jack, or does it really just depend?
Yeah, no, definitely long term, Patrick. They're sort of pretty passive holders of the equity. They do go out and help with marketing and distribution to a certain extent, but certainly putting together that diversified asset classes in uncorrelated markets gives you that, takes volatility out of the earnings, and gives us something that's a little bit different to owning just long-only vanilla fund managers, which there are quite a lot obviously listed, as you know, including ourselves.
Yes. We're not going to sink the boots into Perpetual, but nonetheless. So there's the holdings by market cap as at the 30th of June 2021. Alex, maybe just some sort of closing statements around sort of the outlook for for markets and where you think how things will play out over the next little while? We know you guys are stock pickers and just focus on the businesses that you invest in, which is great, but sort of how you think things will play out over sort of the short term.
Yeah, Patrick, I think you said it there. We are bottom-up investors. I think the macro is very difficult.
I love pinning stock pickers on the macro and the outlook. I love it because you all squirm. But anyway.
Yeah, that's it. I mean, look, for us, it's obviously just about sticking to the process and trying to turn over lots of rocks and trying to find, great businesses. But having said that, I think what we've seen in terms of the Delta variant and the lockdown certainly has clouded the outlook for the Australian economy and for the recovery. That being said, I think, a lot of businesses that are listed on the ASX have taken the opportunity over the last 12 to 18 months to really improve their balance sheets, take costs out of the business. So the businesses are looking in pretty good shape, and I think they'll be quite resilient through this period of uncertainty. So I think the outlook is pretty uncertain at the moment, but I mean, you can be confident that the businesses are in pretty good shape as well. Australian consumers have saved a lot of money over the last 12, 18 months. They've received some stimulus payments from the government in a lot of cases, and they've actually saved a lot of money by not being able to travel internationally, not spending money on public transport and things like that. So the Australian consumer is actually in a pretty strong position as well, which is something that's worth noting too.
Understood. Now, Jack, Alex used the analogy sort of turning over the rocks. When you're turning over the rocks at the moment, given how hard the market has run, are you still finding as many opportunities, or do you think valuations are, and obviously it would have been like a picnic for you guys 18 months ago when the market got knocked around, sort of thinking, geez, we can buy this business at this price now. Isn't that amazing? Is it harder to do that now, or there are as many opportunities, you just need to look a little bit harder?
Look, we did add to the portfolio during that, but it's never easy when there's a sea of red and blood on the street. You really have to sort of, everyone says buy in gloom and sell in boom, but we did do some good adding. But a lot of the stuff is like long-term investing. The portfolio doesn't turn over a lot of names, but we're always looking. I mean, this is really why it's a good fund for investors, because we're investing in companies that people haven't heard of, that stockbrokers don't cover, that really, when I say under the radar, like no one would, most people wouldn't know half the companies that we're invested in. So we're always looking. We have a network.
I think you're being very generous there, Jack. I reckon if people looked at your portfolio and knew 10% of them, yeah, I'd be impressed.
And that's the opportunity, because we buy them when they're undiscovered, they grow earnings, they might become a little bit more liquid, or a stockbroker might cover them, and suddenly they're on a lot more people's radar, and that gives you the second kicker. And that's really what we're trying to do. So bring these companies through and be early stage investors, and then let them grow into the market, get brokers to cover them, and their share prices to appreciate even further.
Do the large cap guys get jealous about the opportunities that you guys get with some of the stocks that you can put in your portfolios that they just can't?
Yeah, look, I think that, they're always curious. They don't mind fishing the odd small cap, the big cap guys, but I think this sort of micro cap space, I think they sort of leave it to us.
Cool. Well, thanks for joining us today, guys. We really appreciate it. We know you're both sort of in lockdown in Sydney as well. So thank you for how well the fund has been managed on behalf of our clients. And thanks again for joining us today.
No, thanks, Patrick, and the team. And thanks for everyone out there for your support. Hope everyone keeps well. And we'll look forward to catching up face to face, hopefully at some point in not too far future.
No worries, guys. All the best. Thanks again.
Thank you.
Cheers.